Now, the global financial crisis has underlined in a painful way that the globalized economy is simply a fact. As we know all too well, problems welling up in a relatively narrow segment of the U.S. housing market metastasize into the most serious global downturn since the Great Depression. The onset of the crisis was shocking, but the response was both unprecedented and illuminating. While countries of all descriptions could have responded to this crisis by turning inwards, they instead intensified their collaboration. This occurred most strikingly through the innovative G20 leaders' summits. The leaders resolved to act forcefully, in part by providing the IMF and other multilateral institutions with novel tools and significant new resources. The result was a coherent and powerful policy response that helped to halt the global economy's downward spiral and set the stage for the recovery that is now underway. Among other things, the IMF forecast points to a modest Japanese recovery in the coming year. Japan's exports have been recovering, led by demand from China, but they remain far below last year's levels. Expansionary fiscal and monetary actions have provided important support, but is highlighted by the sharp downward revision of third quarter growth figures in Japan. Domestic demand, especially business investment, still remains weak. So the IMF anticipates that Japan's annual growth figures will turn positive when exports and investment take over from fiscal stimulus as the main drivers of growth. The fiscal challenges ahead are really formidable. IMF projections indicate that government debt in advanced economies will reach nearly 120% of GDP by 2014, up from 70% in 2007. In these circumstances, whittling advanced economies' government debt down to levels consistent with strong and sustainable long-term growth would require large structural fiscal improvements. Just to bring the debt to GDP ratio back down to the level of 2007 would require a structural adjustment of as much as 8% in GDP on an annual basis. This is really a challenge of historic proportions. The debate regarding exit strategies, in my view, has been focused too narrowly. The scope of a coherent strategy for exiting from the crisis extends well beyond the mere sequencing and pace of stimulus withdrawal. Rather, it encompasses the restoration of the sustained global growth of the pre-crisis years while avoiding the policy mistakes that ignited the crisis. And in this context, I'd like to highlight two particular challenges. The first related to the recent return of capital inflows into the emerging market economies, and the second related to the future sources of global growth itself. In resolving each of these, I should note, Asia is going to play a crucial role. Capital controls also represent an option for dealing with sudden surges in capital flows. They may be appropriate when surges are interpreted as temporary, perhaps reflecting external developments as much as anything, and when other measures are simply not proving to be effective, or that they could not be applied quickly. But temporary capital controls should not be used to paper over real problems or to avoid needed policy adjustment. Above all, we should be open-minded. All tools have their uses, but all tools have their limitations. The IMF, for its part, views these options flexibly with the best response, depending on the specific circumstances. The Japanese government's commitment to rebalance growth away from exports toward domestic sources seems appropriate. Private domestic demand in Japan accounts for nearly 2/3 of GDP, but it has grown by a mere 1% annually since 2000. That's 1/5 the growth rate for exports registered over the same period. Now, it's only natural that discussions about rebalancing growth inevitably touch on the issue of exchange rate policies. Based on our analysis, many Asian countries' currencies are undervalued relative to their major trading partners when viewed in the context of medium-term multilateral equilibrium values. As long as this condition persists, balanced global growth will be more difficult to achieve. While these policies should be analyzed in a broad context, it seems inevitable that increased currency flexibility in many Asian countries, including China, will form part of the rebalancing effort.